Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement, presented by Chris McIntire, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning with our money, with our investments for our financial and retirement future. He is president and founder of McIntire Retirement Services. Chris McIntire here with us. And Chris, the week before Christmas and all across Lake Erie, everybody was worried about their money, but still kind of cheery. So I don't know.
Yeah.
How are things going there at McIntire Retirement Services?
Well, I'm wearing my shirt here. It says Grady White Boats. That's the kind of boat we have. And I'll tell you, it cost a lot more to put gas in it here in Lake Erie than it did a few years ago. And hopefully we get a reprieve on that. But it's certainly been a challenging year here. No question about it. You know, bond prices were depressed. Stock prices obviously were depressed pretty significantly. At one point, the price of Amazon stock was down 46% year to date, that is. And, you know, so I suppose disappointing would be a good analogy to use from the investor side of things and the investor advisor side also.
Yeah, absolutely. So, Chris, I mean, despite the economic and the market challenges and the inflation and interest rates, is this a year where we still had the possibility of making financial progress or achieving milestones or financial goals?
Yeah, you know, Peter, you don't get to become a millionaire all overnight. It takes time. Wealth buildup is going to ebb and flow with, certain market conditions. It's not the first time we've had a down year in the market by any stretch. 2018, for example, they raised interest rates, stocks and bonds were down, real estate was down. It's been a different year in 2022 where real estate has been one of the bright shining stars. So if you were a third stocks, a third bonds, and a third some sort of real estate holding, it wasn't all that bad. You might have, you certainly weathered the storm a lot better because one of those asset classes actually went up in value. And I can only speak to that on what we use, obviously. Some of the listeners might have done some different pieces there. And, so some things that we helped clients do this year, Peter, was convert assets to Roth IRAs when they were down in value. We slid them from a IRA account into a Roth account, and hopefully they will recover tax-free. So hopefully we paid less tax on it because the asset price was lower when we converted it and let that asset price increase where it's tax-free. The other side of that is in the non-IRA aspect is we sold a lot of things that had losses on them. So we call that tax loss harvesting, where you can deduct some of those losses off of your income taxes and then carry the balance forward if you can't offset them with capital gains. If that makes sense, I'll throw it back to you there for some comments.
Yeah, well, opportunity amid chaos, it sort of sounds like there, Chris, is that despite the challenges that we've faced, there are, for strategic, proactive planners, still beneficial moves that we can make. And ladies and gentlemen, before we get going any further, I do want to remind you that if you've got questions or concerns, if you'd like to end this year or start next year off on a better financial footing and path, pick up the phone and give Chris McIntire, your resource, a call, 800-868-1194. That's 800-868-1194, 800-868-1194. And Chris, maybe the biggest challenge to any of us this time of year is just trying to maintain and stick within our budget. I know that is kind of the day-to-day challenge that we face during the holidays.
Oh, yeah, absolutely. And, I gotta have, that's kind of where we do the we're the wants versus the needs this time of year. That's for sure. And, I really want this for Christmas, or my daughter, my son, whatever wants this for Christmas. They may not need it for Christmas. So, hopefully people are have the ability to still fulfill some of those goals. Obviously, it's nice to do discretionary spending, and with inflation and whatnot this year, I think once the results come in January, wouldn't be surprising to anybody listening to the show if those numbers aren't muted, substantially. And then what does that mean going forward into 2023? I think sometimes we watch like the employment numbers quite a bit, and some of that data comes out, about the first, second week of the month. And December had a pretty strong jobs report. So did November. And you're starting to see some layoffs pretty much in the white collar side of things. Is that trend going to continue into 2023 as the impact of rising interest rates? Is it going to curb growth of the corporations? And, so some of the challenges certainly, have not been put to bed by any stretch with these interest rate increases that we've had.
It sounds like, Chris, what you're saying is you don't think that we're completely out of the woods yet, despite the fact that we had a couple really good months toward the end of this year. October in particular, I know, was one of the better months on record for several of the stock market indices, but we can see good moments among bad trends and in the midst of challenging times. And I know you also talk about the fact that some of the best times happen directly after some of the worst times in the market. But again, circling back, it sounds like you feel like we should still be a little bit more conservative or defensive in our stance. We may not be through this cycle of a challenging market and economy.
Sure. And obviously this is going to be age related as well, where you're at in the point of your working years. For those that are younger and still have 5 to 10 years of work to go, good buying opportunity right now with stocks being down. No question about that, even through, a potential recession, because you come out on the other side of that over the long run. For those that are, dependent upon the retirement assets that they have accumulated so far in life. And, we've had many of these conversations. Look, I need to go forward. I don't want to go backwards anymore. And, with bond prices being down, that's what a lot of retirees invest in to cushion the blow. And some of the impact of rising interest rates is somewhat temporary because of their raising interest rates. Once they get done with this rate cycle, you'll see some of those bond prices come back. Bonds also mature. You get your face value back, where stocks, obviously go down in value. And until that stock gets back to where it was, you're worth less money. A bond is different because it has a maturity value. So trying to educate people, and I mean, how many times have we done this throughout 2022 on the difference with how a bond behaves versus how a stock behaves.
But Chris, without a true plan in place to give us some guidance, trying to just kind of guess our way through that or luck into making the right decision at the right time is inherently difficult, if not next to impossible, to get right consistently.
Yeah, no question about it. And, so a lot of times you're going to draw up, all right, here's my investment plan, and then here is my income plan. I've got a client, I hope he's listening today. They live down in the Tiffin area, and he's big on buckets. So, here's my low to moderate risk bucket. Here's my medium bucket. Here's my higher risk long-term bucket. So yeah, all those assets show up on the statement and are reflected in the overall value, but maybe his low risk bucket, didn't fall nearly as much as what the high risk bucket did. And then on the other side of that, if we come out of the call it the economic slowdown, I'm going to call it a recession for what it is, as the market recovers, he'll make more money in the higher risk bucket than he is his lower risk bucket, no question about it. But it does give you the ability to say, all right, hey, I need some assets. What assets are we going to liquidate to do what I need to do? We're probably not going to take it out of the ones that are down in value. We'll take it out over, out of safe money, if you will. We're big safe money people. We didn't talk about that yet today. we have been very strong advocates with the rising interest rates. We certainly have other instruments that we can utilize that haven't been out there in some time to, alleviate risk.
Chris, it sounds like that segmentation and differentiation from different pieces of our money can be one part that we design and implement in the planning process that can give us a lot of additional confidence regardless of what conditions may bring about into the future.
Yeah, a great example is, when people are 72 years old, they have to take required minimum distributions. And if they only have an investment portfolio that, the Vanguard 60/40 model at one point was down nearly 20% this year, well, if you had an account that didn't lose any money or even made a little bit of interest, wouldn't it make more sense to take the money out of that than the other pile of money that was already down 20%? It's like, why make a situation even worse? So again, having that alternative as part of the plan and, thinking sometimes outside of the world of, the traditional 60/40 stock bond, ratio is an example of what I just gave you.
Well, Chris, you've given us actually a few different specific scenarios. You said if somebody's 10 years out from retirement, this may be an opportunity. That's my boat, right? I've seen a few of these over the course of my investment lifespan where I'm trying to invest as much as possible in the challenging times because I know those dollars are going to work the hardest. But if somebody's in retirement, a different situation, if somebody's got a bond portfolio, probably something that has affected and impacted them. And if somebody is of RMD age being forced to take distributions, a completely different scenario and set of circumstances for them and how it impacts them. So, conclusion, a very specific and individualized approach there at McIntire Retirement Services based on the specific client, the specific individual situation. It's not a one-size-fits-all thing when it comes to this planning.
No question about it, Peter, because, we have so many people with individualized risk tolerances. Even in a husband and wife situation, you may have a husband that says, look, I just believe in stocks over the long haul. I'll be fine. If the wife is going to play it a little bit safer, then I'm going to play it a little bit more aggressive. So that's a good example of, even in an individualized household, how you can customize portfolios, based off the overall risk tolerance. If someone's looking for income, then you're going to take a look at, good quality bonds paying a good interest rate. You're going to look at, income-based stocks or dividend-based stocks. You're also, maybe looking at some real estate holdings where there's income coming in from leasers or renters, and then maybe even something in the annuity space kicking off of an income. If somebody is, on the other side of that and says, look, we've got great Social Security and great pensions, we're out of the norm anyway. Then you can, customize something that probably gives them more growth potential because they're not worried about income. They're meeting that already. A couple of examples.
Absolutely. Well, again, ladies and gentlemen, to individualize, customize, and optimize your plan, pick up the phone and give Chris McIntire a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, I could sort of see this going a few different ways. I could see in general this time of year, because everybody's got other priorities, maybe they're putting planning on the back burner and you're not hearing as much, but maybe with this year in particular, as difficult as it has been, maybe you're hearing even more activity and people wanting to double check on things. And then certainly I know into the new year, people want to get their plans together. They want to make those resolutions for financial progress moving into next year. What is it like around McIntire Retirement Services generally this time of year and then specifically this year?
Sure. And the month of December and November, even this year, we're incredibly busy with, distributions, tax loss harvesting, some things that we, don't always run into. In 2021, we didn't have that because the market was up. 2022 market was down, tax loss harvesting, qualified charitable distributions for folks with the required minimum distributions. We promote that quite a bit at our office, which just simply means if you've got a distribution coming out of an IRA, you can pay some or all of that and even more to a qualified charity. And it is a lot of extra work at our office to do that. It's much easier just to have somebody get a systematic distribution instead of them saying, what, this year I'm going to do things different, which means all new paperwork, right? We've got a lot of that's pretty labor intensive for us. And then also, the week between Christmas and New Year's, we really try to slow things down. But I have a conference that starts in the first week of January, so it's just there's always something going on, and
no rest for the weary, no downtime.
No rest for the weary. Yeah, no rest for the weary. We have a lot of snowbirds that are getting ready to go, so a lot of times they want to refill the cash reserves while they're down in Florida or the Carolinas or Arizona, wherever it may be. So we really don't get the craziness is November and December, and then it's just consistently fairly busy. And we try to take the procrastination aspect away from it, because that's just simply an emotion that people have to say, look, I need an excuse to not do something, and our job is to, hey, you do need to do this. This is good for you, and try to gently prod, I suppose, a pretty good analogy.
Well, Chris, I know that there are certain aspects that are absolutely deadline driven, and those are probably the things that keep you very busy October, November, and even into December. And for many of them with processing time, I'm sure deadlines have already passed.
Yes.
for getting things done in 2022, which is why you have to be very proactive in getting the word out about those type of things. But there are also some things that are simply strong suggestions, maybe not absolutely deadline driven. For instance, taking those RMDs. I know in certain years it makes sense to take them closer to the end of the year. In certain years, it may make sense to consider taking them earlier rather than later, and Roth conversions and things like that you have talked about that have to be done within the year, but you've got some leeway of when. What are you seeing for 2023? Do you have any guidance or suggestions for individuals that may need to do some of those kind of financial maneuvers?
Yeah, I would suppose by April 15th, we'll have contribution deadlines for IRAs and Roth IRAs and then, we may do some more Roth conversions earlier in the year if stock prices come down again, which is typically something we do later in the year, right? Because how much money you've spent. You've kind of easier to do tax planning, after you're 9 months of the way through the year, because you can forecast what you're going to need money for.
No big surprises at that point in time, hopefully, right?
Yeah, correct. Somebody didn't say, hey, you know what? Well, we've decided to buy a house instead of convert, so if we wait until September, we got that kind of leeway. But some of this is going to be market driven, and where are the equity prices? So Roth conversions will be something we're probably going to work on, based off of equity performance here to start 2023. And I probably would set my expectations, if I was an investor, generally speaking, for not a lot of overall bullishness probably here in the United States. And if we get some break on the Russia, Ukraine, the China, Taiwan, China easing up some of their COVID policies is certainly going to help the supply chain. So I think, buddy, right now there's just a lot of geopolitical forces out there, right? We're going to have the Republicans in control of the House of Representatives. We'll see how, what that does with legislation. And traditionally, stock markets like, a divided government, because you're not going to get overwhelming, sweeping new regulations that come in. It would be in bits and pieces, so to speak. And that's usually good for companies that want to do some forecasting. And, an example would be, if you were British Petroleum right now and they're talking about curtailing fossil fuels, why would you want to put more money into your fossil fuel division? where obviously on the Republican side, we'll probably get a little more reprieve there, where it'd say, look, more energy is better for everybody around the globe at this particular moment in time. Yep.
But if there's a stalemate and they don't do anything, then it's business as usual for those kind of corporations.
Yeah, there you go. Yep.
I get your point.
Yeah. We kind of shake our head at it that, yep, but sometimes less is best. But, I think if we look at what has happened to energy prices here, just around the globe, but just in the last 18 months or so, that it would certainly be in people's best interest to have more energy choices than less energy choices. I don't think that's rocket science.
Well, one thing with energy this time of year where it's dark for so long, I have less energy, Chris, but I know that you are an early riser. You are up and at the gym, running 9 miles on your Peloton bike, staying in shape. How about for you personally? Any kind of resolutions? Like, I can't imagine that it's much more than keep at it from a health standpoint. But what do you hope to accomplish into the next year?
Yeah, and as you know, Peter, we've lost a couple of pretty good buddies here in the industry, and one had a major stroke. We had another one that we lost after a long-term illness. So some of that stuff still hitting pretty close to home, and some aging parents is, we'll focus on the health side of things, no question about it. And, making sure you're getting out to enjoy things. Stress is a killer, especially around the holiday times. You get family dynamics that come into play there, and, how you cut that off. Some of you are going to have a couple of extra martinis. For those of us that don't indulge in martinis, probably a couple extra miles on the Peloton, like Peter said, you get that dopamine going, right?
Everybody's got their thing, right?
Yes.
I guess some of our things are healthier than some of others. But Chris, it's again good to remind folks that this needs to be a constant and an ongoing priority, as well as a constant and ongoing process. It's not just a one-time thing, and you can't make a resolution and then hope that it magically comes true. You've got to do a little bit of work in order to make it happen. You can't just read a book and then improve yourself. And you've got to put some of those things into practice. And we talk about that, but I think that is truly the value of this program, is that it's a constant reminder to make this a priority. And then the true power, the true value is that you give people the ability to apply this information through that complimentary review, that retirement planning strategy session, and formulating along with them the game plan for retirement. Now, what has that process looked like, Chris, when new individuals, savers, and investors have come in this year? What is the process that you've taken them through? What are some of the questions or concerns that have brought them to the conclusion that it's time to maybe make some evaluation of their financial situation and progress?
Yeah. So let's just say somebody's real close to retirement and, within the next 6 months, and they say, I haven't really done much of anything. I got a 401k at work. I've put my money in a retirement lifestyle 2025 fund because I was going to retire in about 2025. That looks like that would make sense. They probably don't have any idea what's inside that retirement lifestyle fund. But then we'll also look at, what are your outstanding debts? Is the house paid for? What is the biggest risk that they may have? Is it healthcare risk? Did mom and dad and grandmas and grandpas all suffer from dementia at some point? Man, that's a key issue, because there's an explosion in the dementia side of things right now, and that's could eventually bring in a nursing home equation. And are you going to have a pension? Do you have some emergency fund sitting in the bank? Is it too much? Do you need to maybe look at some alternatives now that interest rates have come up? And all the different types of portfolio risk. And if it's a divorced person that we're dealing with, hey, you may have spousal benefits from Social Security and might be able to work some magic there, or even widow's benefits as well. Just lost a dear buddy of ours, and told his wife, I'm like, you could file for widow's benefits and take yours at age 70. And, that was an eye-opening experience there, or not eye-opening piece of information, I should say. Yep. So, just to, kind of we start at the macro view, 30,000, and then, kind of bring it in for a landing and create the plan and look at all the alternatives. And, as a fiduciary, we, have an obligation to act in their best interest. That's the win-win. We are in the win-win business here, not the transaction I win business.
Yeah. So like commissions on sales of mutual funds. It's a model that's out there, not your model. Fees on trades and transactions, the buying and selling, the churning of account. It's a model that's out there, not your model. And those are just two examples I can think of off the top of my head that work to help you meet and exceed that fiduciary responsibility, putting your client's best interest first.
Yep. And I'm going to brag on myself a minute here, is that's the way we picked from day one, was the fiduciary standard. We didn't, do it the old way and then see the light like a lot of advisors do. We were on the independent channel anyway. We do a fair amount of insurance business as well. So just to be fair to the listeners, yeah, we do earn commissions on the insurance side of things there, but on the mutual fund money management, individual stocks and whatnot, we want to lower your internal cost, because that's in your best interest. That's in our best interest, because that's how we earn more dollars, as if you earn more dollars. So that is, inherent in what we do. And, we certainly know how to do that, where the average investor's like, they don't know the difference between an exchange traded fund and a mutual fund, and it could be 1%.
Yeah. Which, by the way, not just the cost structure, a difference there. There are some significant differences between mutual funds and exchange traded funds, especially when we get to non-retirement investing. Chris, there are some inefficiencies, we'll call them, with certain investment tools and options that may cause people to pay taxes even if they've lost money, that may be inherent and occur in one investment option where you can avoid it with a very similar investment goal, but a different investment option. And these are the, again, kind of things that you look out for that help not only meet that fiduciary responsibility, but give your clients a benefit.
Yeah, absolutely. And, when Peter's talking about is a mutual fund that may have a manager buying and selling inside that mutual fund. And when you buy and sell and you own that outside of a retirement account, that's capital gains taxes, could be capital losses as well. And then in an exchange traded funds, you don't have that active type of management. So much more tax efficient. You don't pay any gains until you actually sell the fund, if you will. So much more tax efficient. I always describe it as an exchange traded fund as a cousin to a mutual fund, not quite brother, sister, but a cousin, and typically have a lot lower internal costs than a mutual fund. Doesn't mean a mutual fund's the worst thing in the world.
Well, Chris, wrapping up, getting close to the end of the program and the year here. Time moves by so quickly on the show, as it does in life, which is why you always encourage people not to procrastinate. But for the last couple weeks of the year here, anything that you are focusing on, any kind of traditions in the McIntire household? What are your plans, or what do you encourage your clients and maybe other savers and investors to be thinking about this time of year?
Yeah, I think, with everything that we've dealt with this year, we got some health issues with some family members and whatnot. It's just being thankful that we're here, and don't take health for granted there, folks, and focus more on your health. Your wealth also is very important. So health and wealth, let's call it, make a nice riddle out of it. And, you need both of them to have a good retirement, not just one or the other.
Well, ladies and gentlemen, Chris McIntire does make his time available to you, not only here on the program, giving general guidance and important reminders, but on a specific individual custom level to craft and create and execute and implement your game plan for retirement. If you've got investment and retirement accounts that you've got concerns about what you've seen this year, if you'd like to bring those different accounts and those different pieces of the puzzle together to formulate a plan, if you'd like to review and assess the risks that you're taking, the fees that you're paying, the taxes that you may be liable for, how to maximize your retirement income through sources like Social Security and or pensions, plus what your portfolio can generate for you. These are all things that Chris McIntire helps his clients address and optimize on a daily basis there at McIntire Retirement Services. So whether you want to end this year on a good note or start next year with a confident plan in place, pick up the phone and give Chris McIntire and McIntire Retirement Services a call. 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, always a pleasure, my friend. And this will be our last live program for the year. So I just want to wish you a very Merry Christmas, Happy Holiday, and have a Happy New Year as well.
Yeah, appreciate it, buddy. Always good to chat with you. Many, many years here, and look forward to a prosperous 2023, buddy.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.